So this is chapter 8, and we're going to be covering application. So we're going to apply taxation. So when government imposes tax, on goods and services, what does it mean for the welfare of the consumers, the producers, right? Okay, so remember, without tax, in chapter 7 we covered consumer surplus and producer surplus, right? Without tax, right? So that's just basically this, where you have your price or quantity, you have your equilibrium price, you have your equilibrium quantity, and then we talked about consumer surplus is the difference between your willingness to pay and the actual equilibrium price. So willingness to pay is the highest point of the curve, right, of your demand curve, which is here, and this whole gap, the difference between the willingness to pay and the equilibrium price, gives you your consumer surplus. So basically this whole triangle, right? This whole triangle. Okay. And remember, there could be like increase in price. So if there's an increase in price, then the consumer surplus is definitely going to reduce to just this upper parts of the triangle, right? So it's just going to be this upper part of the triangle if there's an increase in price. Okay. All right. So basically this, let's just call these letters A, B, and C. Assuming that, market price stays at EP and it doesn't go up, then the consumer surplus is going to be letters A, B, C. Okay, so how about producer surplus? Producer surplus is the exact opposite. Producer surplus is the difference. So remember, consumer surplus is your willingness to pay minus the equilibrium price, and producer surplus is the difference between equilibrium price and the production cost, right? So basically the difference between this equilibrium price and this low minimum point right here of your supply curve, right? Okay, so this other shape is your producer. So this whole ABC is your consumer surplus, and this whole triangle is your producer surplus. So remember, it's always a triangle, right? Okay, triangle, triangle. Okay, but at the same time, your cost of production could go up, right? If your cost of production goes up, then the producer surplus definitely is going to come down, right? Or if your equilibrium price comes down, then producer surplus is definitely going to reduce as well, right? So there could be any change in price anywhere in between. But now let's assume that we have letters D, E, and F for this lower part of the triangle. So therefore, that is going to represent your producer surplus, right? So D, E, F. Okay, so keep that in mind. That's a very simple case of consumer surplus and producer surplus without tax. So without tax, you only have producers and consumers in the market. So therefore, what is your total surplus? Your total surplus is simply going to be the combination of your consumer surplus and your producer surplus, okay? However, what we're going to be learning in chapter 8 is when there's tax, there now become three economic agents, right? So now you have your consumer surplus for your consumers, you have your producer surplus for your producers, and you have your tax revenue for the government. Okay, so we're going to learn how tax affects and distorts the market. Right? Assuming that we have a market equilibrium price of $6, and at $6 you have 10 units that are being demanded in this market, right? And then the government wakes up one morning and decides to say, okay, we need more government revenue for public goods and services, whatnot, and they decide to impose a $5 tax, right? Now remember, based on the elasticity of the good, the buyer or the seller could bear more of the burden, but typically the sellers try to push as much of the tax to the buyers because they have that kind of market power. But if they push too much of the tax burden to the buyers, then it's going to affect the revenue, and they're going to lose out, right? So there's going to be a split of the tax between the buyers and the sellers. So now let's assume that $3 are pushed to the buyers, right? And then the sellers decide to bear $2 of the tax, right? So if the sellers are paying $3 extra and the current price is $6, then that means the buyers are going to be paying as much as $9, right? Okay, for this good. Okay, and at $9, of course, you know that the buyers are going to respond by buying less of the good. So let's say because of the increase in price to $9, then the buyers only end up buying, let's see, 5 units of the good. Okay, all right. So there's an increase in price and low demand. There's a reduction in quantity demanded. Okay, so you can tell that before the tax was imposed, this whole triangle from this willingness to pay right here up to the $6, this whole triangle was your consumer surplus, right? But now that you have tax imposed and the buyers are paying more tax to the government through the sellers, then you can see that the consumer surplus is reduced to only this triangle. So now this triangle, this little triangle up here is the only consumer surplus. So you see how much the consumer surplus shrinks just to the increase in price. Okay, now how about the sellers? The sellers have to bear $2 out of the $5 tax, and what that means is that they're going to receive less money, right? Because they have to pay their portion to the government. So if the sellers are receiving $2 less, then that would mean the sellers are only receiving $4. Okay? So now the sellers are receiving $4 and only 5 units of the good are being sold. So again, remember, before the tax was imposed, the producer surplus was this whole big triangle right here. This whole big triangle, right? So we called it DEF, remember? And then the consumer surplus was ABC. But now that the tax has been imposed, the seller's producer surplus has shifted, right? So now it is just, this is only how much they're receiving, right? So they're only receiving from $4 up to the cost of production, right? So this is how much they receive. The rest is remitted to the government. So they only have this tiny portion, right? So based on the numbers we distributed before, the consumer surplus now has only reduced from A, B, C, is now only A, right? And now based on what we had before, we had D, E, F, but this tiny portion, which is the F, is what the producers are left with, right? So producer surplus now is only equal to F. Do you see what is happening? So what happens to these other two portions? This part of the B, which was part of the consumer surplus, now is no longer part of the consumer surplus. Where does it go to? It goes to what we call the tax revenue. So now remember, in this market, we have an additional player, which is the government imposing the tax, right? So the tax revenue is the amount of the tax imposed times the quantity of the goods sold. In this case, we know that the amount of tax imposed is $5, right? And the buyers are paying $3 of the tax, which is where this letter B, goes to, right? The extra $3 that the buyers are paying. And this letter D, D for donkey, is the extra $2 that the sellers are remitting to the government, right? So the combination of $3 B plus D is going to give you the $5 tax, right, which the government imposes. And how about the quantity that's being sold? So the quantity that's being sold is just when you drag it down here at this new price, right, of $9 and $4, you see that only 5 units are being sold, right? So therefore, the tax revenue is going to be equal to $5 tax times 5 units being sold, basically equal to $25, right? So you see that the government is getting $25. Or how much producer surplus has been lost. By the time you calculate this C, this part which was initially called C, is the consumer surplus that was lost. Remember, it used to be ABC and now it's just A. So the consumers lost B to the government, and the consumers are going to lose C to the market due to inefficiency. Okay, so remember. And what shape is this C? It's also a triangle, right? So therefore, let's actually quickly do it. So we want to calculate deadweight loss. Deadweight loss is how much surplus is lost in the market, right? So loss in consumer surplus plus the producer surplus loss, okay? And the consumer surplus is equivalent to C. The producer surplus loss is equivalent to E, actually, okay? So we want to calculate the shapes for C and E, right? Okay, so we know that these shapes for C and E are triangles, right? So half, base, and height. What is the base? So the difference between how much was demanded before, which is 10 units, and how much is being demanded now, which is 5 units, right? So half times 5 units times, what is the height? The extra $3 that the consumers are paying, right? So times $3. So $15 divided by 2, that's going to give you $7.5, okay? So that is for C. How about for E? It's the same concept, half base times height. The base is the same. 5 units less goods are being demanded. And how about the height? $6 minus $4, that's the $2 tax, the $2 that the sellers have to remit, okay? So 5 times 2 gives you $10 divided by 2, which gives you $5, okay? So the consumers are losing $7.5 and the producers are losing $5. That adds up to $12.5, okay? So you see that the deadweight loss is $12.5 and the government gains $25, okay? So the government is gaining tax revenue at the expense of the producers and the surplus, okay? So that is what deadweight loss means. And that is how the consumer surplus and the producer surplus shrinks while the tax revenue goes up, okay? How about the total surplus with tax? So we know that the total surplus without tax is just consumer surplus plus producer surplus. But the total surplus with tax is consumer surplus plus producer surplus plus total revenue, okay? So in this case, you calculate the consumer surplus. You could do the calculation by yourself. Okay, so the last thing I want to explain in chapter 8 is something called the Laffer curve. So basically what this means is that the higher the tax revenue, right? So the government initially imposes a tax, you still buy the product, right, even though you have to pay more. But as the tax increases, you reduce your quantity of the product. But because the price is so high, even though you're reducing your quantity of the product, the government is still making their money, right? So they're still getting the tax revenue. But if the government gets too confident or, gets too excessive and raises the tax way high, right, it raises the tax too high, then eventually the tax revenue is going to decline, right? So increase in tax leads to increase in tax revenue up to a certain point when it reaches its peak. and then the tax revenue is going to eventually decline if tax continues to increase, right? So this is how the Laffer curve looks, and it just shows that tax cannot be too excessive. If not, the government is going to lose out on the tax revenue because the consumers are going to stop reducing their demand for the product and just switch to another product entirely, right? So the government is going to lose out on tax revenue for that market. However, deadweight loss is totally opposite. So deadweight loss is just, remember, deadweight loss is this portion, right? This triangle portion here. The higher the tax, the higher the deadweight loss. So that doesn't go in opposite directions, right? So no matter how high tax is, deadweight loss is going to keep on increasing, right? So that just tells you that the tax really distorts the market, and if tax gets too excessive, then the inefficiency in the market is just going to be exorbitant, right? So the deadweight loss graph is going to look something like this. It's upward sloping, it's forever increasing, right? So the higher the tax, the higher the deadweight loss, okay? All right. I might as well just call this DL, deadweight loss for DL. Okay, and that's that for chapter 8.